Jay, we hear a lot about cap rates and yields in real estate investing, but you wrote an article recently about replacement cost as a focus for multifamily investors. Can you tell us about that?
Yeah, I did. And I don't want to say that cap rates and yields don't matter anymore. They do, but they just don't tell the whole story. With today's high interest rate environment and housing shortages, I think investors are really increasingly looking at where they are buying in terms of replacement costs is really an important barometer for the investment decision. If they can buy a multifamily asset at like 75% of what it would cost to build new, that might suggest they're getting a good deal, especially in a market where supply is tightening and rent growth is coming.
So the thinking is that buying below replacement cost gives investors an edge.
Yeah, that's exactly the idea. Even though in the short term the yields may be low, the underlying market dynamics, we're talking about supply and demand here, right? The rising rental demand, at some point will hit limited new construction, limited new supply, and that's going to drive long-term value. At some point, rents have to increase enough to justify new construction. And then at that point, investors who bought at a discount to replacement cost, obviously in a strong position.
So what's causing the dwindling supply of multifamily construction?
Interest rates are the big culprit, right? The cost of capital is higher. So when rates jumped in 2022, we really entered a new environment. Financing became more expensive. This made it harder for developers to make deals pencil out. And as a result, there are fewer new apartments being built, while demand is going to continue to grow.
But there's also risk. What should investors be cautious about?
There are absolutely some risks. I'd say the first risk is really non-controllable expenses. These are things like real estate taxes, insurance, that are increasing. They can eat into profits, and then that really pushes out the cost feasibility horizon. The other thing that can be complicated are markets that are already oversupplied. So we think about markets like Austin or Nashville. They already have a big glut of supply, so it's going to take them longer to work through. And then I think the third thing that comes into play in certain markets is when local governments start to implement rent controls, right? And so what they're really doing there is they're just appropriating an asset from the owner by limiting what that owner can do in terms of rents. That again pushes the development horizon and makes it less feasible from a cost perspective to be able to build.
So defining replacement costs isn't straightforward. What makes it so tricky?
Well, unlike hard construction costs, which are pretty easy to quantify, right? Things like land value, developer's profit, those are harder to pin down. So land value, of course, depends on things like zoning and entitlements and demand, right? But in the case of developer's profit, you're dealing with really a cost of available capital and risk. And so these are some sort of squishier areas, which leads estimating replacement cost to be a little bit more of an art or possibly a combination of art and science.
Yeah, sure. So given all this, how are investors approaching the multifamily sector right now?
Well, I think the important thing to remember here is it's not just about what the asset is worth today, but it's about what you expect the asset to be worth in the future. And if you're buying below replacement costs in a market that has solid fundamentals and those risks are mitigated, you have a built-in advantage. And it's also, really critical to just look at the local conditions and make sure you understand things like rent regulations, cost inflations, and the groups that can navigate those complexities well will be best positioned for long-term success.
Fascinating. Well, thanks for coming in and sharing those thoughts with us.
Thanks, Steve.